Welcome to the Great Divorce Podcast, hosted by divorce financial analyst and retirement planning counselor Andrew Hatherley. Join Andrew and guest experts as they help late-life divorcees build the financial and mental foundation for a meaningful future. There is life after divorce. Now, on to the show.
Hey everybody. A few episodes ago, I did an episode focusing on annuities. If you remember the discussion, I explained how annuities are a financial product that provide a stream of income, typically used for retirement. The annuity is a contract between you and an insurance company where you pay money now in exchange for a regular stream of income in the future. I went over the various types of annuities and how variable annuities can provide challenges when being divided in property settlements and divorce. I also warned you that in many cases annuities are sold as a cure-all type of investment by dedicated annuity salespeople. Well, today I want to talk about life insurance. Just life insurance. Now, maybe in a future episode of the podcast we can talk about health insurance, disability insurance, homeowners and renters insurance, auto insurance, travel insurance, and pet insurance, something I know quite a bit about. We're not going to get into commercial or business insurance or specialty insurance for your corn crop or your daughter's wedding or even kidnapping or ransom insurance if you're an executive doing business in Kabul or Beirut. Today we're focusing on life insurance. And this can be a complicated subject because life insurance, as it applies to divorce and re-divorce, can show up in many different aspects in the divorce process. You may have pure insurance, otherwise known as term insurance, or you may have cash value life insurance, which shows up on the marital balance sheet. I've dealt with some cases recently where a huge proportion of the client's assets were in cash value insurance, far more than I felt was necessary. It was clear to me that this insurance had been sold to the client as a cure-all, rather than the insurance being a strategic part of their overall wealth and estate planning. Dividing cash value life insurance in divorce can be tricky because it's both an insurance contract and a financial asset. And we're going to discuss that among other things. Another key role of life insurance in the divorce process is to ensure future spousal support or alimony payments. I want to get into all the above shortly, but first I think it's necessary that we have a short primer on the various types of life insurance out there. For the purposes of this discussion, I'm not going to discuss final expense or burial insurance or group life insurance either. Let's keep it simple and deal with the two principal categories of life insurance: term or temporary insurance, and permanent or lifelong life insurance. Now, term life insurance is the simplest and least expensive type of insurance. It provides coverage for a fixed period of time, for instance, 10, 20, or 30 years. It pays a death benefit if the insured dies during that term, and it has no cash value. It's pure and simple life insurance. Typically, you'll find it being purchased by young families as income protection or as mortgage protection if one of the principal wage earners should die. Of course, in divorce, we know income protection can be needed with spousal support or alimony, and term life is often a good solution for a spouse receiving alimony so that he or she is protected if the payer spouse should die before the alimony is fully received. We'll get into that more shortly. Permanent life insurance is more complicated. There are several types of permanent life insurance that combine lifelong coverage with a cash value component. And this cash value is a savings or investment that grows tax-deferred. There are some tax benefits here. Whole life insurance offers a guaranteed death benefit and fixed premiums. The cash in the account builds at a guaranteed rate, and the policyholder can borrow against that cash value. You often see this with conservative savers. It can be used in estate planning, and provides long-term, lifelong security. You don't have that risk with term insurance that you buy a 20-year policy and the insured passes away a day after the term ends, leaving the beneficiaries empty-handed. Another type of permanent life insurance is universal life insurance, which is more flexible than whole life. Here you can adjust the premiums and the death benefits. The cash value grows based on an interest rate that's not necessarily guaranteed. Universal life insurance, or UL, is more flexible and offers more growth potential than whole life insurance. Indexed universal life insurance, or IULs, are similar to universal life, but the cash value growth is tied to a stock market index like the S&P 500. Typically, IULs have caps on how much the cash value linked to the index can grow, maybe an 8 or 9% cap. But they also typically have floors so that if the market goes down 20%, your floor may be zero, not a negative. Variable universal life insurance has the cash value invested in sub-accounts, which you may have heard with annuities. They similarly have sub-accounts, which are like mutual funds. Once again, there's higher growth potential, but also higher market risk, and these policies tend to be suitable for investors more comfortable with market risk. Finally, we have guaranteed universal life insurance, or GLs. These are a hybrid between term and permanent life. They provide lifelong coverage, but with little to no cash value, and while costing more than term, they cost less than a typical whole life policy. They can be seen as a more affordable permanent coverage without the investment focus. Okay, with that exciting review of the various types of insurance out of the way, let's get into how life insurance can be used to protect a person receiving alimony payments in divorce. So, purchasing life insurance to secure spousal support in divorce is a common strategy to protect the receiving spouse's financial well-being in the event of the payer's death. In fact, it may be legally required, either by court order or agreed upon in the divorce settlement. Many divorce decrees require life insurance to cover alimony or spousal support, so it's important that the amount of coverage matches the terms of the divorce decree or separation agreement. Typically, the death benefit will match the total obligation of spousal support. For example, let's say you receive $4,000 a month for 10 years. That would be a total of $480,000 in coverage needed. This might be adjusted in consideration of inflation or future obligations, for example, spousal support increasing or perhaps continuing beyond the expected duration. Ideally, the recipient spouse should own the policy or have control over it, even if the paying spouse is insured. This ensures that the policy can't be changed or allowed to lapse without you, the receiving spouse, knowing about it. And the recipient spouse or trust, if appropriate, should be named as an irrevocable beneficiary. The insured ex-spouse can't change the beneficiary to his new wife or girlfriend. Term life insurance is usually sufficient for protecting spousal support. It's more cost-effective and can be easily matched to the duration of the support obligation. You're receiving alimony for 5 years, have the insured get 5-year term insurance. 10 years, 10-year term. Permanent life insurance might be appropriate if support is indefinite or if there are estate planning or cash value needs, but it's going to be more expensive. Typically, the spouse paying alimony covers the premium cost, but this can be negotiated during the divorce settlement. Sometimes the premiums are deducted from support payments or even shared. Obviously, age and health status are going to greatly impact premiums and insurability. Older age usually means higher premiums, and medical exams and underwriting are often required, and pre-existing conditions may limit options. If the payer spouse has serious health issues, life insurance may be very expensive or even unavailable. One thing I always recommend is that medical underwriting take place before the divorce is final, so alternative solutions can be reviewed. Alternative solutions might include annuities or setting aside assets in trust or escrow or a larger lump sum settlement in lieu of support. Another thing I always recommend is that the recipient spouse should have a copy of the policy and regular confirmation that premiums are being paid and that the policy is active. The divorce agreement should have built-in language that notifies the recipient of any policy lapses or cancellation and allows the recipient to take over premium payments if needed. As I mentioned a few moments ago, the ideal situation would be for the recipient spouse to own the policy and have control over it, even if the paying spouse is insured. Let's shift gears now from looking at spousal support payments to the marital balance sheet. When dividing a cash value life insurance policy in divorce, the first step is to identify what type of policy it is. We just discussed that. We then need to confirm who owns the policy and review the policy statements for cash value, surrender charges, and outstanding loans. We need to know what the premiums are and what the death benefit is. Then we need to determine whether the policy is marital property or separate property, or a mixture of the two. If premiums were paid during the marriage with joint funds, well, that portion is certainly going to be marital. If a policy predates the marriage, the court may see it as partly separate and partly marital growth. When valuing the policy, we need to look at the cash surrender value, not the death benefit, and we've got to subtract any policy loans or surrender charges. Then there's the issue of how to divide the policy. It can simply be canceled and the cash value split, but of course that ends the insurance coverage. One spouse might keep the policy and the cash value, and the other spouse receives an offset of equivalent assets, which might be cash or retirement assets, whatever. This is a common practice. Ownership might be transferred to the non-insured spouse. This is useful if that spouse wants to maintain coverage for financial protection. But of course, we can't ignore who pays the future premiums. Another option is that the policy is retained but assigned to secure alimony or child support, just like a term policy might be. Another important step is to address beneficiary designations. These need to be confirmed and updated in the divorce decree, but importantly also with the insurance carrier. Sometimes courts will require that the ex-spouse or children remain beneficiaries, especially to secure alimony or child support. Next, a decision needs to be made on who's going to pay ongoing premiums if the policies are maintained. What happens, for example, if the responsible spouse stops paying? And, of course, this is extremely important, the tax implications need to be understood. Surrendering the policy may create taxable income if the cash value exceeds premiums paid into the policy. Note also that loans become taxable if the policy lapses or is surrendered. Of course, under Internal Revenue Code 1041, transfers between spouses as part of divorce are generally non-taxable. With most divorcing couples, equity in the house and retirement plans or pensions are the main assets. But I've seen cases where cash value life insurance is the main asset and people have far more insurance than they really need. Cash value life insurance can play an important role in investment planning and estate planning. But when you see 90% of the client's assets in cash value life insurance, you have to wonder what's going on, particularly if this is not an ultra high net worth situation. In my experience, I see certain professions to be more targeted and sometimes more susceptible to life insurance sales pitches. And this often comes down to their income levels, the characteristics of their jobs, and even cultural or social factors. I found that doctors and healthcare professionals particularly are prime targets of life insurance salesmen. Lawyers may also have high incomes and complex estate planning needs. The same goes for business owners, corporate executives, and high net worth individuals across many professions. Often these busy professionals rely on agents to simplify decisions, which sometimes leads to less scrutiny. And many professionals have very specialized focus but limited financial education. Of course, anyone can fall for a sales pitch if they aren't fully informed or if they're being sold a complex product that exceeds their financial knowledge. My position is always to look at the unique needs of the client I'm speaking with. Cash value life insurance can be an excellent complement to traditional retirement vehicles and for high net worth individuals. It can offer tremendous tax advantages. I also like the ability to incorporate long-term care insurance into cash value insurance as an additional benefit. This is a feature offered by some cash value life insurance policies. Many cash value insurance policies can pay off in 3 different ways. The first is the obvious death benefit. The second is access to potential tax-free loans from the growing cash value of the policy. And the third is the access to a long-term care benefit based on the amount of the policy's death benefit should a long-term care situation arise. My advice to you is to educate yourself as much as possible about life insurance and to ask questions and to seek independent advice. I've seen some people on the internet advise speaking to a retirement specialist who doesn't sell insurance. I understand where they're coming from, but consider that the retirement planner may be overly biased against insurance if he doesn't sell it at all. I think the most important thing is to seek advice from someone you trust or that comes reliably referred from someone you trust, that you seek advice from someone with integrity, whether they sell insurance or not. A financial advisor who understands the potential benefits of life insurance in estate planning and the complementary benefits of cash value life insurance to traditional retirement plans, but not someone who sees life insurance as the be-all and end-all. When I work with clients who have more complex investment and estate planning needs, I bring in an insurance specialist who I've vetted rigorously both for their expertise and for their client-first approach. Often, in the meetings that my clients and I have with these insurance specialists, I'll pose lots of hard what-if type questions to the specialist to ensure that my client understands the products being discussed and to be confident that those products meet their needs. If you have any questions about insurance policies you have or the role insurance is playing in your portfolio, particularly if you're getting divorced, please reach out. I'd be happy to chat with you. You can find me at transcendretirement.net. Until next time, take care.
Thanks so much for tuning in to this episode of the Grey Divorce Podcast. To learn more or get in contact with your host, you can visit Andrew's website at transcendretirement.net. Also, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. That helps others find the show, and we greatly appreciate it. Thanks again for listening, and we'll catch you in the next episode.
Information provided is educational only and should not be construed as legal or tax advice. Each situation is unique and should be discussed with your tax or legal advisor prior to implementation. Andrew Hatherley is not an attorney and does not provide legal advice. Information provided is financial in nature. Advisory services offered through Hatherley Capital Management, LLC. Divorce financial analysis services offered through Wiser Divorce Solutions, an affiliated company.